Let me ask you something that most people never think about until it's almost too late. You've spent 20, 30, maybe 40 years building your retirement nest egg. You've sacrificed, you've saved, you've watched your portfolio grow, and then the day finally comes, the day you actually retire, and suddenly you realize nobody ever taught you how to spend it. How much do you take out? From which account first? What happens if the market crashes in your first year of retirement? These are the questions that can make the difference between a retirement that lasts a lifetime and one that runs dry 10 years too soon. And today we're going to answer every single one of them. Welcome back to the channel. If you're new here, this is where we break down complex financial topics in a way that actually makes sense for real people. And today's video is one of the most important ones I've ever made, because retirement withdrawal strategy is genuinely one of the most underrated topics in personal finance. Everyone talks about how to save for retirement. Almost nobody talks about how to withdraw from it intelligently. So buckle up, because this is the most complete breakdown you're going to find anywhere in 2026. Let's start with the foundation, because before we get into specific strategies, you need to understand what we're actually trying to solve here. When you're in retirement, you're no longer adding money to your portfolio, you're drawing it down. That means every dollar you pull out is a dollar that can no longer compound and grow for you. Pull out too little, and you live a smaller life than you need to. Pull out too much, and you outlive your money. And here's the thing most people don't consider. The sequence in which your returns happen matters just as much as the average return itself. This is called sequence of returns risk, and it's one of the biggest hidden threats to any retirement plan. If the market drops 30% in your first 2 years of retirement, and you're withdrawing at the same time, you're selling assets at a loss to fund your lifestyle. And those shares you sold cheap, they're gone. They can't participate in the recovery. This is why the strategies we're about to cover are so critical. They're not just about math. They're about protecting your financial future against things you can't predict or control. Now, the most famous withdrawal strategy in the world is the 4% rule. You've probably heard of it. The idea is simple. In your first year of retirement, you withdraw 4% of your total portfolio. Then, every year after that, you adjust that dollar amount for inflation. So if you have $1 million saved, you take out $40,000 in year one. And if inflation runs at 3%, you take out $41,200 the following year, and so on. This rule comes from a study done back in the 1990s called the Trinity Study, which analyzed historical market data and found that a portfolio of roughly 60% stocks and 40% bonds could sustain this withdrawal rate for at least 30 years in almost every historical scenario. But here's where we need to have an honest conversation, because in 2026, the 4% rule needs some serious context. When that study was done, bond yields were very different, life expectancy was shorter, and we're now living in an era where many people retire at 60 and could spend 35 or even 40 years in retirement. Some financial researchers have updated their analysis and suggest that a more conservative rate, closer to 3 or 3.5%, might be more appropriate for longer retirement horizons, or if you're retiring into an environment with elevated valuations and lower expected future returns. That said, the 4% rule is still a solid starting point. Just don't treat it as a gospel truth that applies to every single person, regardless of their situation. So what are the alternatives? Let's talk about dynamic withdrawal strategies, because these are where things get really interesting. Instead of taking out a fixed inflation-adjusted amount every year, regardless of what the market is doing, dynamic strategies adjust your withdrawals based on your portfolio's performance. One of the most practical versions of this is called the guardrail strategy. Here's how it works. You set an initial withdrawal rate, let's say 4%. Then you define an upper guardrail and a lower guardrail. If your portfolio grows so much that your current withdrawal rate falls below, say 3% of your current balance, you give yourself a raise. you increase spending. But if the market drops and your withdrawal rate climbs above, say, 5 or 5.5% of your current portfolio, you tighten the belt. You cut spending by 10% until things recover. This approach keeps you flexible. You spend more when you can afford it, and you pull back when you need to, which dramatically reduces the risk of running out of money while still allowing you to enjoy your retirement when markets are doing well. Another powerful dynamic approach is the percentage of portfolio method. Instead of withdrawing a fixed dollar amount, you simply withdraw a fixed percentage of whatever your portfolio is worth that year. So if you decide on 4% and your portfolio is worth $1 million, you take $40,000. But if the market drops and your portfolio is worth $800,000, you only take $32,000. This naturally forces you to spend less in bad years and more in good years, which is actually very sustainable mathematically. The downside is that your income becomes variable, which can make budgeting harder. But if you can cover your essential expenses with Social Security and maybe a pension or annuity, then having a variable top-up from your portfolio is totally manageable for most people. Speaking of which, let's talk about the bucket strategy, because this is probably the most psychologically comforting approach for a lot of retirees. The concept is straightforward. You divide your money into 3 buckets. Bucket 1 holds 1 to 2 years of living expenses in pure cash or money market funds. This is your short-term spending money. Bucket 2 holds somewhere between 3 to 7 years of expenses in more conservative investments. Think short to medium-term bonds, dividend stocks, or balanced funds. Bucket 3 holds everything else in growth assets, equities, real estate investment trusts, and long-term growth investments. In retirement, you live off Bucket 1. When Bucket 1 gets low, you refill it from Bucket 2. And periodically, when markets are doing well, you refill Bucket 2 from Bucket 3. This structure means you never have to sell stocks in a down market because your short-term needs are covered by safe assets. It gives you tremendous peace of mind and keeps you from making emotional decisions when markets get volatile. Now, one of the most overlooked components of any withdrawal strategy is account sequencing, meaning which accounts you pull from first. And getting this wrong can cost you tens of thousands of dollars in unnecessary taxes over the course of your retirement. The general conventional wisdom is to withdraw from taxable brokerage accounts first, then tax-deferred accounts like your traditional IRA or 401k, and then finally your Roth accounts last. The logic is that you want to let your tax-free Roth money grow as long as possible, and you want to delay taking money out of your traditional accounts to delay the tax hit. But in 2026, with Roth, accounts more widely available than ever, and required minimum distributions kicking in at age 73, there's actually a strong case to be made for a more strategic approach. In the years between retirement and age 73, if your income is relatively low, you may be in a lower tax bracket than you will be once Social Security and RMDs kick in together. That window is a golden opportunity to do Roth conversions, moving money from your traditional IRA to your Roth IRA and paying taxes now at a lower rate so that money can grow and be withdrawn tax-free later. This is called a Roth conversion ladder strategy, and for many people, it can save a significant amount in lifetime taxes. Let's also talk about Social Security timing, because it ties directly into your withdrawal strategy. You can claim Social Security as early as 62, at your full retirement age, which for most people today is 67, or as late as 70. Every year you delay past your full retirement age, your benefit grows by about 8%. That is a guaranteed, inflation-adjusted, 8% return. You will not consistently beat that in the stock market after accounting for risk. So for many people who are healthy and have other assets to draw on, delaying Social Security while withdrawing from your portfolio in early retirement actually leads to a much higher lifetime income. It also helps reduce your exposure to longevity risk, the risk that you simply live longer than your money does. Now I want to address something that a lot of financial content skips over: the emotional and behavioral side of retirement withdrawals. Studies have consistently shown that retirees dramatically underspend their savings out of fear of running out. They live more frugally than they need to, skip experiences they could afford, and ultimately leave behind large estates they never intended to. This is a real problem, and it comes from anxiety more than math. Having a written withdrawal plan, an actual document that says, here is how much I will take, here is the order I'll take it from, here is the rule I'll follow when markets drop, removes a huge amount of emotional decision-making from the process. It keeps you on track in bad times and gives you permission to actually enjoy your money in good times. And finally, let me bring this all together with a simple framework for thinking about your own strategy. First, figure out your baseline income: Social Security, pensions, annuities, the money that shows up regardless of the market. Then figure out the gap between that income and your actual spending needs. That gap is what your portfolio needs to fill. From there, choose a withdrawal strategy that matches your risk tolerance, your flexibility, and your timeline. If you need certainty, lean toward a more conservative rate and consider annuitizing a portion of your assets. If you have flexibility in your spending, a dynamic or guardrails approach gives you more upside. And no matter what, think carefully about account sequencing and tax planning, because the difference between a smart and a careless withdrawal strategy in terms of taxes can be staggering over a 20 or 30-year retirement. This stuff matters deeply, and it's worth taking the time to get it right. If you found this video helpful, please give it a like. It genuinely helps this channel reach more people who need this information. Drop your questions in the comments below, because I read every single one. Subscribe if you haven't already, because we cover topics exactly like this every single week. And if you want to go even deeper, I'll link a video right here that breaks down Roth conversion strategies in full detail. I'll see you in the next one.